Chapter 1. Before anything else, before charts, before indicators, before strategies, there is something you need to understand about trading that almost nobody tells you at the beginning. Trading does not reward enthusiasm. It does not reward intelligence the way school does. It does not reward effort the way a job does. And it definitely does not reward urgency. Trading rewards restraint. It rewards patience. It rewards people who can sit in uncertainty without needing immediate resolution. That's why so many beginners struggle right out of the gate. They arrive motivated, curious, hungry to learn, and eager to act, and the market quietly punishes every one of those impulses. When you're new, it feels natural to think the first step is learning how to win, how to read charts, how to find entries, how to predict direction. That feels logical, that feels productive, but it's backwards. The first thing a new trader has to learn is how to not lose. Not emotionally, not financially, not psychologically. Because most trading careers don't end with one big dramatic failure. They end slowly through confusion, frustration, and self-doubt that builds session after session until the trader no longer trusts themselves. The market doesn't test your strategy first, it tests your expectations. New traders arrive expecting progress to feel linear. They expect learning to feel like improvement. They expect effort to produce results. And when that doesn't happen, when they study for weeks and still lose, something breaks internally. They start questioning themselves. They start forcing trades to prove their learning. They start believing the problem is that they haven't found the right strategy yet. In reality, the problem is that they started trading before understanding what trading actually demands from a person. There's a version of you right now that believes trading success is about figuring things out. That once you understand the market, things will click. Losses will make sense. Confidence will appear. That version of you is not stupid. It's normal. But that version of you is also dangerous because it's impatient in a game that requires patience and hopeful in an environment that punishes hope. The market doesn't care how new you are. It doesn't care how hard you're trying. It doesn't slow down to teach. It simply reacts to behavior. And beginner behavior is predictable. New traders trade too much. They risk too much. They watch too closely. They think too much. They react too quickly. Not because they're reckless, but because they're searching for certainty. They want to feel grounded in a space that offers none. So they cling to indicators. They cling to opinions. They cling to YouTube videos and Discord chats and signals and confirmations. Anything that reduces the discomfort of not knowing. But the discomfort is the point. Trading is built on uncertainty. If you try to escape that, you'll fight the market constantly. There's a story that plays out over and over. A new trader opens a chart for the first time and feels overwhelmed. Candles move fast. Price jumps unexpectedly. Nothing behaves the way they imagined. Then they learn a strategy and suddenly things feel clearer. There are rules, there's structure, there's logic. Confidence rises, the first trade is placed with excitement. Sometimes it wins, sometimes it loses. Either way, emotion spikes. The trader feels something, and that feeling becomes addictive. From that moment on, trading stops being about learning and starts being about chasing that feeling again. Relief after a win, validation after a good call, hope after a loss. This is where most beginners get stuck, long before they ever realize it. If you're new and this sounds familiar already, like the video now, because recognizing this early can save you years of frustration. Not later. Now. The biggest mistake beginners make is thinking trading is about action. It isn't. It's about decision-making under pressure. And pressure doesn't come from the market. It comes from expectation. When you expect to make money quickly, every trade carries weight. When you expect to prove yourself, every loss feels personal. When you expect progress to be visible immediately, patience disappears. And without patience, discipline never has a chance to form. There's a trader named Jake who started trading with a small account and big expectations. He watched videos every night, he took notes, he practiced on demo. When he went live, he felt ready. The first few days went well. A couple wins, a little confidence. Then came the losses. Small at first, then larger. Jake responded the way most beginners do. He traded more. He stayed on the charts longer. He tried to make it back. Every decision felt urgent. Every trade felt important. Within weeks, the account was gone. Jake didn't quit because he hated trading. He quit because he stopped trusting himself. The losses weren't what broke him. The emotional chaos did. That's what no one tells beginners. The real danger isn't losing money, it's losing self-trust. Once that goes, every decision becomes harder. Hesitation creeps in. Overthinking replaces clarity, fear replaces curiosity, and the market starts feeling hostile. But the market didn't change, the trader did. Another beginner, someone newer still, took a different path. She started trading small, almost annoyingly small. Losses barely registered. Wins didn't excite her. She focused on one setup only. She traded less than she wanted to. She stopped after losses even when it felt premature. She journaled emotions more than results. Progress was slow, boring even. But something important happened. She never felt overwhelmed. She never felt desperate. She never felt the need to prove anything. Months later, when she increased size, her behavior didn't change. That consistency became her edge. The difference between these two traders wasn't intelligence or work ethic. It was expectations. One expected trading to deliver something quickly. The other expected it to test her patience. The market rewarded the second one, not because she was smarter, but because she was aligned with reality. If you're new, you need to hear this clearly. Trading is not a way to escape where you are quickly. It's a way to build skills slowly. The moment you try to use it as a shortcut, it turns against you. The moment you respect it as a craft, it starts to cooperate. That cooperation isn't luck. It's the result of behavior that doesn't trigger the market's natural traps. Every beginner wants to know when they'll become profitable. That question itself is a trap. Profitability is not a moment. It's a state. A state where losses don't knock you off balance. A state where you don't need every trade to work. A state where boredom replaces excitement. That state is built long before the money shows up. And if you chase the money first, you'll never reach it. If you've ever felt overwhelmed, rushed, or confused since starting trading, comment, "Start slow," because that mindset shift is the foundation everything else sits on. Learning the right things doesn't protect a beginner trader from losing money. In fact, sometimes it makes the losses more confusing. You start to recognize patterns. You understand concepts. You can explain what price is doing after the fact. On the surface, it feels like progress. Internally, it creates a dangerous contradiction. You feel knowledgeable, but your results don't reflect it. That gap between understanding and outcome is where impatience is born. Impatience doesn't show up as recklessness at first. It shows up as urgency. You feel like you're close, like you're just one adjustment away. You start telling yourself that if you can just apply what you've learned more often, things will click. So you trade more. You watch more sessions. You look for more opportunities. What you don't realize is that you're turning learning into pressure. And pressure is poison for beginners. The market has a strange way of punishing urgency. The more you want to trade, the worse your timing becomes. The more you try to apply knowledge quickly, the less precise your execution gets. That's because learning something and embodying it are not the same thing. Embodiment takes time. It takes repetition without emotional consequence. Most beginners never give themselves that space. They try to perform before the skill is stable. There's a phase every beginner goes through where they start seeing setups everywhere. Every chart looks tradable. Every move feels actionable. This isn't intuition, it's overstimulation. You've learned just enough to recognize shapes, but not enough to filter quality. Without filters, everything looks like opportunity. And when everything looks like opportunity, discipline collapses. A beginner trader named Luis experienced this perfectly. When he first started, he barely traded. He was cautious. After a few weeks of studying, his confidence grew. He started spotting patterns. He felt sharper. That's when the losses accelerated. He entered trades faster. He trusted his bias more than his rules. He didn't realize he was trading more because he felt smarter, not because the setups were better. Knowledge didn't slow him down. It sped him up. And speed without control leads to mistakes. Impatience also shows up in how beginners handle losses. Early losses feel instructional. You shrug them off. But after learning more, losses start to feel unjust. You think you did everything right. You followed the rules, and yet you still lost. That's when frustration creeps in. Not because the loss was big, but because it contradicts your expectations. You expected learning to reduce losses immediately. When it doesn't, you start forcing the market to cooperate. Forcing shows up quietly. You re-enter too quickly after a stop. You widen your criteria just enough to justify another trade. You stay in trades longer than planned because you feel like they should work. The word should becomes common in your internal dialogue. And every time you think a trade should work, you're no longer observing, you're demanding. The market does not respond well to demands. Another beginner story highlights this clearly. Maya took one setup and studied it obsessively. She backtested it. She understood its logic. When she went live, the first few losses shocked her. Not because she wasn't prepared for losses, but because she believed understanding the setup meant it would behave consistently. When it didn't, she felt betrayed by her own preparation. Instead of slowing down, she tried to trade through the inconsistency. She thought more reps would smooth it out. What actually happened was emotional fatigue. She stopped trusting the setup, not because it was bad, but because she expected it to perform on her timeline. This is the lesson beginners struggle with the most. Learning does not immediately translate to results. There is a lag. That lag is where patience is tested. If you can survive the lag without changing behavior, progress compounds. If you react to the lag emotionally, you reset yourself over and over again. The market doesn't reward how much you've learned. It rewards how consistently you apply it under uncertainty. That consistency is impossible if you're measuring success trade by trade. Beginners do this constantly. One trade becomes proof of progress. One loss becomes proof of failure. That emotional volatility makes stable execution impossible. There's also a subtle ego trap here. As beginners learn more, they start identifying as traders. That identity creates pressure. You feel like you should be doing something, like you should be active. Sitting on your hands feels wrong. You confuse inactivity with incompetence. So you trade when nothing is there. Not because you want to gamble, but because you want to feel like you're progressing. Progress in trading is often invisible at first. You don't feel it. You don't see it. It shows up later quietly in how calm you are during drawdown, in how little a loss affects you, and how easily you walk away. Those are the real milestones, not account size, not win rate. But emotional stability. If you're new and you feel like you're learning a lot but not seeing results yet, like the video because that frustration is normal, but reacting to it is optional. In the next chapter, we're going to talk about the one thing beginners almost always underestimate and why ignoring it early makes everything harder later. Chapter 2. What beginners underestimate more than anything else is how much trading is psychological long before it is technical. Most people assume psychology matters later, after you've learned how to trade. In reality, psychology is what determines whether you ever get the chance to learn properly in the first place. The market doesn't wait until you're advanced to test your emotions. It tests them immediately. And if you don't understand that early, you end up fighting battles you don't even know you're in. When you first start trading, the emotional reactions are loud. Excitement before entry, anxiety during the trade, relief or frustration afterward. Beginners usually interpret these emotions as signs of engagement. They think feeling something means they're doing something right. In truth, strong emotion is usually a sign that risk is too high or expectations are misplaced. The market doesn't reward intensity, it rewards composure. Composure is not natural. It's built through repeated exposure without damage. Most beginners skip that step. They trade size that makes emotions unavoidable. Even small dollar losses feel heavy because the account itself feels important. Every win feels like progress. Every loss feels like regression. That constant emotional swing creates fatigue. Fatigue leads to mistakes. Mistakes lead to losses. Losses increase emotion. The loop tightens quickly. There's a trader named Ryan who learned this the hard way. He started with what he thought was small risk, but emotionally it wasn't small at all. Every trade mattered. Every outcome affected his mood. He couldn't sleep after losing days. He replayed trades constantly. He wasn't undisciplined on purpose. He was overwhelmed. The market felt loud, chaotic, unfair. He kept thinking if he could just master the strategy, the emotions would calm down. They didn't. They got worse. The turning point for him didn't come from a new setup. It came from reducing size to the point where losses no longer mattered emotionally. At first, it felt pointless. The wins were tiny, the losses were forgettable. But something changed. He started seeing patterns more clearly. He stopped reacting to noise. He stopped forcing trades. The strategy didn't change. His psychology did. That allowed the learning to actually stick. This is what beginners miss. Emotional safety is required for skill development. You cannot build consistency while your nervous system is constantly activated. You might gain information, but you won't gain control. Control comes from calm repetition. Calm repetition only happens when emotional stakes are low enough to allow neutrality. Another beginner mistake is believing confidence comes from winning. It doesn't. It comes from predictability, knowing how you'll behave regardless of outcome. Beginners often feel confident after wins and insecure after losses. That's unstable confidence. It disappears the moment variance turns. Stable confidence comes from rule following. When you know you'll cut losses, stop trading when you should and avoid revenge trades. You trust yourself. That trust matters more than trusting the market. Psychology also shows up in how beginners respond to boredom. Boredom feels uncomfortable because it's unfamiliar. Many new traders mistake boredom for stagnation. They think if they're not trading, they're not improving. So they create action. They enter marginal trades. They overanalyze. They scroll charts endlessly. All of that creates stimulation, not progress. The market rewards boredom because boredom usually means you're waiting properly. It means you're not emotionally chasing. It means you're letting probability do its job. Beginners struggle with this because they want to feel engaged, but engagement in trading often leads to overtrading. The skill is learning to be okay with stillness. One impulsive trade doesn't ruin an account. A pattern of impulsive trades does. One emotional exit doesn't matter much. Repeated emotional exits destroy expectancy. The danger is that these patterns feel minor in isolation. They only reveal themselves over time. That's why early discipline is so important. It's easier to build good habits than to break bad ones later. Psychology isn't something you fix once. It's something you manage continuously. Even experienced traders have emotional reactions. The difference is they don't obey them. Beginners often think emotional control means not feeling anything. It doesn't. It means feeling emotions without acting on them. That skill takes practice, it takes exposure, it takes mistakes made small enough to survive. If you're new and you've been focusing only on strategies and indicators, like the video because this chapter might be the missing piece you didn't know you needed. In the next chapter, we're going to talk about expectations. Specifically, the expectations beginners bring into trading that quietly sabotage them before they ever have a chance to succeed. Chapter 3. Expectations shape everything in trading, especially at the beginning. Not the expectations you say out loud, but the ones you carry quietly. The ones that influence how you interpret every outcome. Most beginners don't realize how heavy their expectations are until the market starts pushing back. They expect improvement to feel obvious. They expect learning to protect them from losses. They expect effort to translate into reward. And when those expectations aren't met, frustration sets in quickly. The problem isn't that beginners have expectations. It's that the expectations are borrowed from environments that don't resemble trading at all. In school, learning leads to better grades. At work, effort leads to recognition or pay. In most areas of life, consistency produces predictable feedback. Trading is different. You can do everything right and still lose. That reality feels unfair until you accept that outcomes in trading are probabilistic, not merit-based. This mismatch creates a silent conflict. A beginner studies, practices, and shows up disciplined, yet still experiences losses. The mind looks for a reason. It assumes something must be wrong. Either the strategy is flawed, the learning wasn't sufficient, or the trader themselves is incapable. That assumption is dangerous because it turns normal variance into a personal indictment. Once trading feels personal, objectivity disappears. Chris struggled not because he lacked discipline, but because he expected discipline to guarantee wins. Every time he lost while following his rules, he felt cheated. He thought, what's the point of being disciplined if I still lose? That question pushed him to abandon good habits. He started cutting corners, adjusting rules mid-trade, and chasing confirmation. Discipline didn't fail him. His expectations did. One of the hardest expectations to release is the belief that losses should decrease quickly as you learn. In reality, losses often stay the same for a long time while your response to them improves. That improvement is invisible. You don't see it on the equity curve at first. You feel it in how you handle drawdowns, in how calmly you accept stops, and how quickly you reset after a bad day. Beginners often overlook these signals because they're looking only at money. Money is the loudest feedback in trading, but it's not the most important early on. Emotional stability is. If your emotional swings are shrinking, you're progressing, even if the account balance isn't growing yet. If you're reacting less, forcing less, and overtrading less, you're building the foundation that eventually supports profitability. Skipping that phase is what causes so many traders to implode later. Another expectation that causes trouble is the belief that trading success should feel exciting. Beginners imagine confidence as energy, decisiveness, and momentum. They expect to feel powerful. In reality, consistent trading feels quiet. It feels repetitive. It feels almost dull. That dullness is misinterpreted as stagnation, but dullness is often the absence of emotional interference. It's a sign that trading is becoming routine rather than reactive. Beginners also expect clarity to arrive suddenly. They believe there will be a moment when everything clicks, when charts make sense, when confidence locks in. That moment rarely comes all at once. Clarity builds gradually, it sneaks up on you. One day you realize you didn't overreact to a loss. Another day you notice you skipped a trade without feeling anxious. These are the real breakthroughs, but they're subtle. If you're only watching for dramatic change, you'll miss them. Expectation management is about recalibrating what progress looks like. Early progress isn't profit, it's restraint. It's fewer emotional mistakes. It's less urgency. It's the ability to stop trading when nothing is there. Those skills don't feel rewarding at first because they don't feed the ego, but they protect you from the habits that destroy accounts. If you're new and you've been frustrated because trading isn't matching what you imagined, like the video because this realization can save you from quitting too early or forcing progress that isn't ready. In the final chapter, we're going to bring everything together and talk about what beginners should actually focus on first if they want to build something that lasts. Chapter 4. If you strip everything down to its simplest form, what a beginner trader needs first is not a strategy, not an indicator, and not a prediction skill. What you need first is stability. Emotional stability, behavioral stability. A way of operating that doesn't collapse the moment something goes wrong. Without that, everything else you learn becomes unusable. It's like building a house on shifting ground. The materials might be strong, but the foundation can't support them. Stability begins with how you define your role in the market. Beginners often see themselves as participants who must act. They feel like showing up means trading, like progress requires clicks. In reality, your role is not to trade often. Your role is to protect capital while learning how you behave under uncertainty. That alone reframes everything. You're not here to win yet. You're here to observe yourself, how you react to losses, how you handle waiting, how you respond to boredom. Those reactions matter more than any setup you could possibly take early on. A beginner who understands this starts making very different choices. They trade smaller than feels necessary. They stop sooner than feels comfortable. They walk away while the urge to keep going is still present. Those decisions feel counterintuitive because they don't produce immediate reward, but they produce something far more valuable. Self-trust. You begin to trust that you won't sabotage yourself. That trust creates calm. Calm allows learning to take root. Beginners also need to understand that consistency is not something you force. It's something that emerges when friction is removed. Friction comes from oversized risk, unrealistic expectations, and emotional attachment to outcomes. Remove those, and consistency becomes easier. Not perfect. Easier. And easier is all you need early on. Alex started with the same enthusiasm and impatience as everyone else. Early losses hit hard. Wins felt euphoric. Trading consumed his thoughts. Eventually, he reduced size so much that the outcomes barely registered emotionally. At first, it felt pointless. But over time, something changed. He started seeing the market more clearly. He stopped rushing. He stopped forcing. Months later, when he increased size again, his behavior didn't change. That was the difference. The foundation had already been built. What beginners should focus on first is repeatable behavior, not repeatable profit. Can you take the same setup the same way 10 times in a row? Can you accept 10 losses without changing your approach? Can you stop trading when rules say stop? These are the questions that determine whether trading becomes a skill or a struggle. There's also a mindset shift that matters deeply here. You stop asking when trading will work and start asking whether you're working correctly. That question puts control back in your hands. You can't control the market. You can control your behavior. When behavior improves, results eventually follow. Always. The market doesn't reward beginners for effort. It rewards them for restraint. It rewards them for humility. It rewards them for surviving long enough to learn. Most people don't fail because they lack intelligence. They fail because they rush past the phase that teaches emotional control. That phase feels slow. It feels uncomfortable. It feels unrewarding. And it's exactly why it works. If you're new and this video has reframed how you think about starting out, like the video because this foundation matters more than any strategy you'll ever learn. Share it with someone who's just beginning, so they don't have to learn these lessons the hard way. And subscribe because trading done right isn't about hype or shortcuts. It's about building something stable enough to last. If you're a beginning trader, watching this first doesn't make you profitable overnight, but it can save you from the mistakes that end most trading journeys before they ever really begin.